Welcome everybody then to this December 24 question. Let's get straight to the requirement. And all I know this is 8 marks, so that's about 15 minutes. I copy the requirement, I put it in my word processor, and I'm away. Okay, and it says using Exhibit 1 and in accordance with the IFRS 15, discuss how we should allocate a transaction price. Well, discuss. I know how to allocate a transaction price. Allocation of transaction price is normally by standalone selling prices. Got 1 mark out of the 8 already, 3 to go, and I pass. Now let me do a little reminder review for this. So if you remember, if you had 2 different products that you sell, they're 2 different performance obligations. You got to give them product A and give them product B. But we call them different separate performance obligations. If they're bundled together into one, then you have to split that transaction, that selling price there of 800. But product A and product B come to 1,000. So how do we make 1,000 into 800? Well, we just pro rata it. So we do it according to the standalone selling price, which is the 600 and the 400. And all we do is we total them up and we say, right, product A is basically worth 600 out of that 1,000, i.e. 60%. So it should be allocated 60% of the selling price. 60% of 800 is 480. Product B, on the other hand, should get 400 out of the 1,000, i.e. 40% of the 800, which is 320. So we've split up. We've allocated the transaction price into the separate obligations. Really straightforward. Let's go back to the question. So the question said, look at this exhibit. And it said, we're going to sell a hardware package which composes of 3 things. So we've got 3 products here: a computer, a monitor, a printer, and we're going to sell them all for 2,000. So I'm going to immediately set myself up with a little table here, I think. I've got 3 products. I'm going to give myself, I don't know, about 5 rows, columns even. Then how many rows, I don't know, more or less. Go something like that. Okay, and I'm going to say type. No, I'm not. I'm going to say performance obligation. I'm going to be really posh. Then I'm going to say standalone selling price. Then I'm going to say transaction price. Then I'm going to put allocation. Didn't need the rest, but might need them later. But okay, so performance obligation, I've got 3. I've got a computer, I've got a monitor, and I've got a printer. And my transaction price for them all is up there at 2,000. Okay, then my standalone selling price is what I'm looking for. Well, we regularly sell the computers for 1,720 here. So the computer standalone selling price is 1,720. Super. The monitor and the printer, though, are not yet sold separately, so we can't have a standalone selling price. It says, but the competitor sells it a similar printer for 180. So I'm going to have to write something down about that. But the printer 180, so we'll do the discussion later. That seems to be the best we can do. And then the other one, the monitor, it says the cost to produce a monitor is 150. Well, I don't want the cost, I want the selling price. And it says we achieve a gross profit margin of 25%. So let me remind you about profit margins, etc. So if you remember, when it's a markup, costs are 100%. So if profit was 25, the selling price would have to be the balance in 125. Now, when it's a margin, it's the selling price, it's 100%. So once you know the profit, your costs become the balancing figure. Okay, let's go remind ourselves what this was in the question. Gross margin of 25% and costs are 150. Great. So we're looking at a margin. Costs are 150. That's the cost. I want the standalone selling price. So if I know the costs are 150, and I know that represents 75%, I divide it by 75, and I want to gross it up to the 100 to find out my selling price. So if I do that, my selling price must be 200. So let's go put those figures in. So 200. Okay, so what we can now do is say the total of the standalone selling prices is 1720 plus 200 plus 180. And I would write it down like that actually, just in case you don't put it in right. You could use the calculator. Let me quickly show you the calculator. So we could move around. You can change that look between standard and scientific. Just the standard for this one. So 1720. It is quite fiddly, I find personally. So it's easy to make a mistake. So I don't really like using it. I'd rather write it out. But there you go. That's the 2100. Okay. So the allocation would be 1720 divided by 2100. Could do this on the spreadsheet, by the way, but I'm just showing the examiner my workings. Times by, I want to give it 1720 out of the 2100ths of the transaction price. Done. I'm going to do the same for the next one. I'm going to give that 200 out of the 2100. That's the fraction. Times by the transaction price, giving each share of the transaction price. Okay, and then finally the printer, 180 of the 2100 times by 2000 equals that. And that's it. I've split it up. Now, that's done all the calculations. I've done it right. I've definitely got marks for that. Got an extra mark for the standalone selling prices. And then in my own words, I'd say something like, look, we couldn't observe the prices of the others, but we used the market, something like that. So we should use all relevant information that's reasonably available, e.g. we used the competitor price, didn't we, for the printer? Okay, and we should use an expected cost plus a margin approach for the display screen, so something simple as that. There you go, 8 marks, really straightforward. The examiner did say that this was very well answered because it's actually not that technical.